Hello, everyone, and welcome to another episode of the Biofuels Report podcasts. Today, we are going to focus on the Argus US Gulf Coast used cooking oil prices and CME's upcoming listing of the Argus UCO futures contract that will launch December 15th. We are happy to have Elizabeth Hui, Director of Research and Product Development from the CME, join us. I'm Louise Burke, and I handle the business development for renewables for Argus in North America. So just a few facts on the used cooking oil market. We know that the U.S. state and federal policies for renewable fuels, such as sustainable aviation fuel, renewable diesel, biodiesel, all provide additional incentives for fuels that really use lower carbon feedstocks. Specifically in the states, you see low carbon fuel standard programs in California, Oregon, and Washington that really encourage biorefiners to source the lowest carbon material. And so this really benefits UCO over higher carbon feedstocks like first generation vegetable oils. Additionally, the Federal Inflation Reduction Act's 45Z credit, which should come into effect in 2025, barring any political issues, will also be more generous to fuels that produce lower greenhouse gas emissions. So it really incentivizes even more UCO use. So when we looked at the Environmental Protection Agency, or EPA, that's what it's commonly known as, when we looked at their consumption data, that continues to rise. And in 2023, it was close to 7 billion pounds. For those of you not familiar with what UCO is comprised of, it's really the fats and oils that come from commercial or industrial food processing operations. So anybody who's cooking or frying, that oil then becomes classified as UCO, or used cooking oil. So before we check in with Elizabeth on the details of the CME futures contract, I did want to mention that Argus currently has 23 UCO prices globally. We price all the main regions in the US, but the most active market is the US Gulf Coast. In the cash market, prices can be used to negotiate term contracts, spot market transactions, offtake arrangements, etc. So a lot of use for companies to manage their profitability and operations. But we do see price volatility in this market. And I think that's, Elizabeth will give us some details on why risk management and a risk management contract is really key for this market. Just to give you a perspective, UCO prices in the Gulf Coast were as low as 38 cents a pound on January 5th this year, versus their all-time high of 88 cents a pound in March of 2022. Factors that really affect this market include environmental credits, supply and demand of credits. So if there's a change in particularly the D4 RIN credit, that will affect prices, and the state-based credits, such as the California LCFS credit. It's also important to monitor demand for renewable diesel, for SAF and biodiesel. So we can see, for example, biorefinery expansions. That's going to increase the demand, and outages or closures can effectively reduce the demand for feedstocks. For example, in March, we did see one of the major biorefineries close a couple of their biodiesel plants. So that changes feedstocks demand and really does create some of that price volatility we're seeing in this market. So with that summary, I just want to turn it over to Elizabeth. Elizabeth, can you provide us with an overview of, why CME is launching this contract, and what benefits do you think it will provide to the market?
Sure, absolutely. As the US energy markets continue to evolve and decarbonize, there's a greater focus on renewable road transport fuels. Based on customer demand, CME Group is introducing 2 Gulf Coast UCO futures contracts providing market participants with risk management tools. And with this launch, customers will be able to trade their soybean oil futures, New York ULSD futures, and UCO futures at the exchange. So with this launch, we will be listing a Gulf Coast UCO futures contract in 60,000 pounds, and we will also be listing one in 100 metric tons to give the international market some flexibility. And the contract size for the pound contract will be 60,000 pounds,
and the metric ton contract will be 100 metric tons, which will have a minimum price fluctuation of 0.0001, which will give you a value per tick of $6, and 0.01 for the metric ton contract,
which will give you a value per tick of $1. And these are both based on Argus's Gulf Coast UCO assessments.
That's great to hear, Elizabeth. And I am curious about the launch date. When will the contract be launched?
So effective on December 15th for trade date December 16th, we'll be launching both the Gulf Coast Argus 60,000 pound futures and the Gulf Coast UCO Argus futures, which will be available for trading on CME Globex and for submission for clearing via CME Clearport.
And yeah, can you elaborate a little bit more on that? So are these contracts then eligible for block trading, and how does that work?
Sure, these contracts will be eligible for block trading, and the minimum block threshold will be 2 contracts. All block trading is subject to Rule 526. So essentially, these futures contracts can be privately negotiated via the brokers as a block trade and submitted into CME Clearport for clearing. Trades need to be reported by the broker onto CME Clearport within 15 minutes of execution.
Okay, great. It sounds like this is definitely a well-needed risk contract, and I'm glad you brought up the fact that, of course, you have the CBOT soybean oil futures contracts, the NYMEX ULSD. So there's a lot of interrelationships between some of these contracts.
Correct. And originally, when we were discussing with market participants about listing a UCO futures, they had all told us that there's not a pricing mechanism for risk management for specifically UCO. So we had these discussions, and Louise, you and I talked, and here we are listing a futures contract that will be listed out for 12 consecutive months.
That's great. And I do remember our discussions, and also with market participants. I recall one saying that this particular contract will really be a reflection of the renewable fuels market, some of the supply demand characteristics that we've talked a little bit about. So at this point there, of course, you have the soybean oil futures contract, which is used heavily and traded widely, but to have one that's more specific to the renewable fuel industry is quite exciting. So I think that's wonderful. I'm glad to hear also, I think, Elizabeth, you mentioned that there will be 2 separate contracts. The domestic market, of course, trades in cents per pound, but you also mentioned that there would be a one in dollars per metric ton as well.
Exactly.
Great. So that, of course, that's often what we see in the international market. And we know this market, much like any physical market, there's obviously global commodity trades. So I think that sounds like this is going to be a great addition to your risk management complex.
Yes, and we wanted to give participants the flexibility, as you mentioned.
Thanks so much, Elizabeth, for your perspective. I think it's really important that we have risk management contracts. The contract is now available for trade, so we're excited to see this market develop in terms of both liquidity and volume, so stay tuned. So thank you again, Elizabeth, for your participation. And for more information on both the Argus UCO contracts, please go out and check our website, which is www.argusmedia.com. And then, of course, for CME, if you can check their website, www.cmegroup.com, and you can get all the relevant information. So we hope to hear you. We hope that you'll participate in the next series that we'll have coming up shortly. Thanks again, everyone.